When the Federal Reserve raises interest rates, most people expect to feel it fairly quickly. Mortgages get more expensive. Credit cards charge more. Car loans cost more. The economy slows down. Simple enough. But here's what almost nobody explains clearly. Most of the economic damage from a rate hike doesn't arrive when the hike happens. It arrives months or years later, long after the headlines have moved on, long after people have stopped connecting the cause to the effect. And by the time you feel the full weight of a rate change, the Fed may have already changed course again, responding to damage they created 18 months ago. This delay has a name. Economists call it the transmission lag. Milton Friedman described monetary policy as affecting the economy with long and variable lags, a phrase repeated for 70 years because it remains accurate. The Fed is steering a ship where turning the wheel doesn't change direction for a very long time. And right now, in 2026, the Federal Reserve is considering rate hikes in an economy still digesting rate cuts from 2024 and 2025. Understanding the lag is the only way to understand what's actually happening. Let's start with why the lag exists at all. The interest rate the Fed sets, the federal funds rate, is an overnight rate. It's the rate at which banks lend reserves to each other for one night. Most ordinary Americans never interact with that rate directly. What they interact with are the downstream rates, mortgage rates, auto loan rates, credit card APRs, business loan rates. And those downstream rates adjust at completely different speeds. Financial markets react almost immediately. The day the Fed announces a rate change, bond prices move, stock valuations shift, and currency markets reprice. That part of the transmission mechanism is nearly instantaneous because markets are forward-looking and react to expectations. Mortgage rates move within days to weeks. When the federal funds rate rises, the 10-year Treasury yield, which mortgage rates track closely, adjusts fairly quickly. A homebuyer shopping for a mortgage the week after a Fed hike will pay more than one who locked in a rate the week before. But here's where it starts to slow down. The people who already have a fixed-rate mortgage are completely unaffected. Their monthly payment doesn't change at all. A family that locked in a 30-year mortgage at 3% in 2021 doesn't feel a Fed rate hike in 2023 or 2024 or 2025. They feel it only if and when they sell, move, or refinance. And since most homeowners don't move every year, a significant portion of the housing market can be insulated from rate hikes for years. The same dynamic applies to corporate debt. Companies that issued long-term bonds at low rates before the hikes continue paying those low rates until the bonds mature. A corporation that issued 10-year bonds in 2020 at 2% interest doesn't pay higher rates until 2030 when those bonds come due and need to be refinanced. The rate hike exists. The pain is deferred. This is the fundamental mechanism behind the lag. Higher rates only affect new borrowers and borrowers with maturing debt. Everyone with existing fixed-rate obligations continues paying the old rate. The economy doesn't feel the full effect of higher rates until enough of the old fixed-rate debt has matured and been replaced with new higher-rate debt. And that process takes years. A Federal Reserve Bank of San Francisco research paper found that an unexpected 1% increase in interest rates can reduce gross domestic product by as much as 5% over 12 years. Not 12 months, 12 years. The peak effect often arrives 18 months to 2 years after the initial hike, but the ripple continues long after that. It's a structural force that works through the economy slowly, across business cycles, affecting each sector at different speeds. Let's map how it actually moves. The first sector to feel it is housing. New buyers face higher mortgage rates immediately. Home builders see demand fall. Existing homeowners feel locked in. They can't afford to sell and buy at the new higher rates, so they stay put. This reduces housing supply and creates the paradox of a slowing market that doesn't see prices fall quickly because nobody wants to sell. The housing market seizes more than it crashes. The second sector is business investment. Companies considering new factories, new equipment, or expansion face a higher cost of capital. The project that made financial sense at 4% borrowing costs doesn't make sense at 7%. Investment decisions that take months or years to plan get delayed or canceled. But because business planning cycles are long, the pullback in investment doesn't show up immediately in employment data. It shows up later, when the projects quietly deprioritized fail to materialize. The third sector is consumer spending, and here the lag is longest and most complex. Some consumers feel rate hikes immediately. Anyone with a variable rate credit card, an adjustable rate mortgage, or a car loan coming due. But consumers who are fully employed, have fixed rate debt, and have savings buffers may feel essentially nothing for an extended period. The 2022 to 2023 rate hiking cycle is a perfect case study. The Fed raised rates at the fastest pace in 40 years, from near 0 to 5.5%, and the economy continued growing. Unemployment stayed low. Consumer spending remained elevated. Many declared victory and questioned whether the old rules still applied. They still applied. The effect was just delayed. By 2024, the slowdown began materializing in the labor market. Hiring decelerated. The June 2026 jobs report showed only 57,000 jobs added, roughly half of what economists expected, and April and May were revised down by a combined 74,000. Some portion of that labor market softening reflects forces set in motion by rate hikes from 2 and 3 years earlier. The transmission was not faster than history suggested. It was exactly as slow as history suggested, and people were surprised anyway. Now here's where it gets directly relevant to 2026. The Fed cut rates 3 times in late 2024 and early 2025, reducing the federal funds rate by a combined 0.75 percentage points. Those cuts are still working their way through the economy, and at the same time, the Fed is now considering rate hikes again. 9 of 18 voting members project a hike before year-end, and markets are pricing roughly a 60% probability of a September increase. This means the Fed may be adding new restrictive pressure to an economy still absorbing both the restrictive pressure from 2022 to 2023 hikes and the stimulative effect of 2024 to 2025 cuts, all simultaneously. This is the fundamental challenge of monetary policy with long and variable lags. The policymaker making a decision today is responding to data that reflects decisions made 18 months ago. The decision they make today will produce its main effects 18 months from now. There is no way to precisely calibrate that. There is only the best available judgment about where the economy will be by the time the policy takes effect, made with incomplete information about a system that responds slowly and unevenly. Milton Friedman's original warning was not just that lags are long, it was that lags are variable. The 2022 rate hikes produced effects faster in some sectors. Housing seized almost immediately, and much more slowly in others. Any attempt to fine-tune the economy with monetary policy runs into the fundamental problem that you don't know exactly how long the lag will be this time. So what does this mean for you, practically? If the Fed hikes rates in September 2026, the full economic effect of that hike won't arrive until 2027 or 2028 at the earliest. Your mortgage rate may move immediately if you're looking to buy. Your credit card APR may inch up within months, but the broader effects on employment, business investment, and consumer spending will take much longer. And here's what most people miss. By the time the pain from a rate hike is clearly visible in the data, the Fed has typically already begun cutting rates again in response. That's not incompetence. It's the unavoidable consequence of steering a system with an 18-month lag using real-time data. The Fed doesn't control the economy in real time. It sends signals into a system that responds slowly, unevenly, and with a delay long enough that cause and effect are rarely visible at the same moment. The next time you hear that the Fed raised rates and wonder why your grocery bill hasn't changed, that's the lag. Give it 18 months, then look again.